Welcome to the Smarter Money Life podcast hosted by Andy Mattingly. Frequent guest on local TV news, regular segment on Indy Now TV, and a leader here at Forum Credit Union. Forum's mission is to help members lead their financial dreams, and in today's podcast, we're going to cover a topic that will help you improve your financial life. Are you confused about the difference between an appraisal and an inspection, or maybe a prequalification versus a preapproval? Have you ever thought about how much you need for a down payment or if you can get down payment assistance? Hello, everyone. This is Andy Mattingly, and I'm back today to talk about the home buying process. From learning about terms to what they mean in sharing programs that might be helpful to your situation. And with me today is one of our mortgage gurus, Erin Schmidt. Erin is the AVP of Mortgage Processing. Thank you, Erin, for joining us today.
Thanks, Andy. Happy to be here.
Well, very good. So we're going to jump right in, and we're going to start with just what are some of the terms that people should understand about the mortgage process? Because, I get questions about this all the time. And so what are some of the terms you think people should really understand and why they're important?
Oh my gosh, there are so many different terms that we use on the mortgage side of the world, but just kind of want to start off with the prequalification versus a pre-approval that you touched on. Both of these are letters that a lender that you choose to work with will give you, which estimates your purchase price and your loan amount. And those are based on your credit, your debt, your income, and your assets. But you do need to expect that your lender will pull your credit before giving this letter, and that things could change from the time you're issued this letter to the time you apply and begin your mortgage process. Another important definition is your rate lock. The rate lock is how you lock in your rate to verify that it will not change as you go through the purchase process. The purchase process can take anywhere from 30 days to 90 days, and having that rate locked in with the volatility in the market is very important.
What's a typical length of a rate lock?
A typical length of a rate lock is between 30 and 60 days. If you are purchasing a home and you know that the construction won't be done for 90 days, or you would like to make your closing date further out than that 60 days, the 90-day lock option is available. But most of the time we see them in the 30-day range.
Okay.
Earnest money. That's a really important part of the purchase money process. Usually this is 1% of your home purchase, and it is something that the buyer gives to the seller basically to reserve the home.
And you can lose it, right? If you decide, if for your reason you say, I don't want to buy this home now, and there's no good reason, then you have to walk away from it and the seller gets to keep it, right?
Yes, absolutely. The seller can keep that money if the buyer determines that they no longer want to buy the home. Now, if there is a decline for some reason, or there is inspection issues, or another valid reason, then that's where your realtor can step in and work directly as your advocate on the buyer's side with the seller's agent to maybe split that earnest money in half, or maybe get you your full amount back.
Okay, good to know.
Yeah.
Any other terms?
Appraisal versus home inspection. That is going to be really important. As a buyer, you want to make sure that you get a home inspection. A home inspection is done by an inspector, and this verifies or reviews the condition of your home. The difference between an appraisal and a home inspection is the appraisal is done by a licensed appraiser and actually gives the value of your home. You will not expect to get the value of your home from an inspector.
Yeah, and inspections are great because they tell you if there's something significantly wrong with the house, like a foundation issue, electrical issue. There's a lot of people who do DIY and they don't have a lot of things up to code. The bathroom in the basement may not be up to code or things like that, right? So that's the important part of that.
Absolutely. In my opinion, you always want to get a home inspection unless you're buying a home as is. A home inspection tells you what's great about the home, tells you what's wrong about the home, and gives you the opportunity to talk with the seller and maybe ask them to complete some repairs. That way you're not moving into a home knowing that you need a new roof in 5 years, and that's $20,000 out of your pocket. Maybe you can negotiate that into your purchase.
And another thing that I try to tell people is you should do a home inspection even if you're building a home.
Absolutely.
Because you want your person to go in and say, did they really do everything right? Are the windows in right? Are all of those things even in a new home? So I think inspections, people don't really realize how important they are.
So important. Absolutely.
Part of the mortgage process, and I know a lot of people complain about it, but it's very important. There are just so many documents that we need. So can you talk about some of those and why they're kind of important in an approval process so that people can understand, why they're needed and how useful they can be?
Yes, absolutely. The most important documents in a approval process is going to be your income and your assets. as well as your government issued driver's license or ID. So we have to know who you are, right? So that's where the ID comes in. But as far as assets go, typically a normal request is 2 months of all pages of your bank statements or your 401k statements or both. That's going to tell your lender how much money you have to be able to bring to closing or for your down payment. Another thing that's really important are your income documents. So think pay stubs, W-2s, possibly your tax returns, 1099s if you're a contractor. That's going to tell your lender what you make and help base your loan qualification off of your monthly income. Those are always standard documents that are asked for. If you tend to think that your loan officer hasn't asked for everything or something changes, you want to take that document and put it aside so that it's readily accessible when it is asked for, because it will be asked for.
Yeah, that makes sense. So, one of the things that I know that you've shared with me from time to time is that some people, and I use the term mistakes, but it's just that they make a decision once they're under contract, we're in review and processing, and they make these little mistakes. So can you kind of explain some of the things that people should avoid doing when they're in the process of getting an approval for a mortgage?
Absolutely. This is probably my favorite question. I kind of broke this into some do's and some don'ts.
Good.
So to start off, don'ts. You don't want to use your credit for big or abnormal purchases while you're going through the mortgage process. You also don't want to open new credit while you're going through the mortgage process.
So what you're saying is if I want to buy furniture for the place, I shouldn't go out and do that until I've actually closed my mortgage?
That's exactly what I'm
Okay.
saying.
Okay.
Absolutely. Because your debt to income is such an important fact of how you qualify. And sometimes putting that new couch on a credit card is going to change your debt picture. And we would hate for you not to qualify for a loan because now you've got an extra payment on a credit card that didn't exist before.
And then a couch that probably doesn't fit in your apartment.
That's exactly right. Exactly. Some of the other don'ts is try really hard not to move money around. We find a lot of times that people are receiving payments from friends or family for services done, or they're transferring money between checking and savings accounts. That makes the process a lot more difficult for the lender to source where those funds are coming from. So try to leave the money in the same account that it's come in as.
And another thing, because I personally ran into this when I was doing a mortgage, is that I have nicknames on my accounts that show up on the statement. And I had one that said tuition fund. And they're like, is this a student loan? I'm like, well, no, it's a deposit account. It's where we put the money to pay for tuition. They're like, oh, okay. So, I mean, you can trip yourself up even when you're just, organizing your own life.
You
So,
absolutely can. I mean, it's part of what we do to kind of dig in and look at
yeah.
some of the things that are going to cause some risk or that are going to open questions that need to be answered. So very important. Moving on to the do's. These are really important. You definitely always want to notify your lender of any changes. Often, we expect people to still go through life while they're doing a mortgage loan. If your job's going to change and your income picture is going to change, absolutely talk with your loan officer about it. If the terms of your home purchase change, meaning that the purchase price changes or you want to put more money down, talk to your loan officer. Let us help you through that. Always promptly respond to your lender with requests for additional documentation. That way we can continue to keep the loan moving forward and we're still meeting the close date that is set by the realtors. Always, always, always do a walkthrough of your home the day before or the day of closing. That is so important. We've had situations where a pipe has broken and all of a sudden buyers are walking into their new home and it's flooded because they didn't walk through the home beforehand. So that is so important to make sure you're doing that walkthrough.
And I'll put a plug in for then when you're choosing a realtor. That's a good question you should ask them. Will you walk me through the home the day I'm closing? Because good realtors will do that. And people that don't know what they're doing don't even think of that. So that's such an important do.
Absolutely. Absolutely. And then the last do is make sure that you're asking questions freely to your lender. We're here to help you. So no question is a stupid question. Most people haven't bought homes before. We do this all day, every day. So ask the questions that are weighing on you and give us the opportunity to guide you in that direction to make your process go smoother.
Yeah. And you mentioned about asking questions. And I think one of the questions people are a little bit timid or afraid to ask is about down payments and the fact that maybe they don't have enough money. And so can you share with our audience a little bit about some of the down payment assistance programs or even the lower down payment loans that we have? Because, a lot of people's parents say, well, you need 20% down or more, or you can't buy a house. So can you kind of talk through this whole down payment mystery that's out there?
Absolutely. And that is kind of a misnomer. You don't need 20% down anymore to buy a home. There are several lenders, Forum included, who offer 100% financing options. So you would need to bring your closing costs to your closing, but those can be somewhere in the neighborhood of $2,000 to $5,000, which is a grave difference than bringing a 20% down payment to the table. Also, there are several programs like FHA and VA that assist with lower down payment requirements, even if you find a lender that doesn't offer a 100% program. Also, your local housing department will have programs that are available to you. So, for example, there's the Indiana Housing and Community Development programs that are available. Also, federal home loan banks in your area. I believe there's several across the entire country, but they also offer down payment assistance programs that are in the form of grants. And all of these that I'm talking about don't always have to be repaid back. So, some of them, you just need to stay in your home for 5 years and then they're forgiven. Some of them, there's not even a residency time frame requirement, but we've been really fortunate here at Forum that we've been able to offer several of these programs and help out a lot of members with some down payment assistance.
The other thing is to kind of clear up with down payments. You can get a gift for a down payment. And I know that some people don't think that you can, but you can, right?
You absolutely can. It'll depend on your program most of the time, but absolutely, if you have a grandparent or a parent, relative family member, we want to stick with family members, but if they want to give you some money for a down payment, it is called a gift. There is sourcing that's required for it from the lender perspective, but absolutely take advantage of that.
So another thing that a lot of people are hesitant to ask is that, if they've been open and honest with each other, you have co-borrowers and one of them has bad credit and one of them has good credit. So what are some of the ways, because I feel like sometimes people are like, oh, there's no way we're ever going to buy a home and because they have bad credit. And so what are some of the ways that people can navigate that situation, to get into a home when we have something like that?
That's a great question. First off, I would say check with your individual lender for the credit score requirements or the different applicable programs. There are some programs that allow a FICO score down to 500, 580, 620. So you definitely just want to have those conversations with your lender and find out what programs are available. If you have found your lender and you do need to get a credit score higher than what you currently have, if you have the time to be able to do it, meaning that you're looking to purchase in the next 6 months, not in the next 30 days, a lot of lenders will sit down with you and will give you advice on how to increase your credit score. That's very applicable for not just buying a mortgage, but just in life to be able to increase your credit score. Sometimes it involves paying off credit cards. Sometimes it involves opening some new credit cards and giving them some seasoning time. But that's definitely an option for you. Another option would be to remove your co-borrower. If you can hold the payment on your own with your income, then let's remove that co-borrower. They can still be on title and have ownership to the home. They're just not obligated on the note. The final option that I would give would be adding a non-occupying co-borrower. So potentially adding a parent who is not going to live in the home, but who can lend their income and their credit expertise to the file to be able to help you qualify individually.
Yeah, that's all of those things are great things that people need to remember. And the big key is just back to what you said, talk to your mortgage loan officer, share everything when you're getting into this, and they'll get you going on the right place. Now, another question that everyone has is they've been told that private mortgage insurance is terrible. You need to avoid it. But can you kind of clear up the mystery of, does it last the entire loan or can it be removed and how does that happen? Because I think, pulling back the curtain on this will help a lot of people understand a little bit more about private mortgage insurance.
All right, private mortgage insurance, or PMI as it's more commonly known, is usually placed on a loan when your loan to value is over 80%. However, it does not need to last for the entire term of your mortgage. It can be dropped when your loan balance, your principal loan balance, hits 78% of your home's original value. That is automatic. Your servicer will automatically drop your PMI when you hit that 78% mark, as long as your payments are current. If you would like to proactively drop your mortgage insurance, home values increase. Sometimes it takes a minute to hit that 78% loan to value requirement, but your home value has gone up. You want to proactively drop this and see what the value is. You can pay for a full appraisal with your servicer, and depending on what that loan to value is and what that servicer's requirements are, you could potentially drop your PMI a lot earlier than hitting the 78% with the natural progression of paying down your loan. I do encourage you to talk to your individual servicer, though, because while it's an industry norm and an industry requirement that you will drop at 78%, if you've only been in your home for a year, you may not be able to drop your PMI with a full appraisal when you get just under 80%. There may be some additional requirements. So talk with your servicer, but it is absolutely an option to remove your PMI as long as you're in the right product. For example, FHA loans, you can never drop that mortgage insurance as long as you're in an FHA product. But for a conventional product, absolutely, it's available.
Yeah, and that's one of the things that we, two things on that. If just because you've been in your home for a year, and if you've not really done any improvements to it, likely you're not going to be there, especially if you only put 10% down. So I always caution people to say, well, how much did you spend on it before you decide that you're going to do that? And the second thing is that I always try to tell people, don't avoid a mortgage because you might have to pay PMI, because if you look at your mortgage payment plus the PMI, that might still be less than your apartment. And even if you're paying PMI, at least you're building equity in your home. So I think those are a couple of things that I always try to tell people, don't be afraid of PMI, right?
Yeah, absolutely. PMI is not a bad guy. It's not the bad thing.
No.
It is so necessary for a risk perspective, but it doesn't mean that your payment is going to be blown out of the water or that your home is going to be too expensive. It's just kind of a necessary evil.
Yeah, it helps you get in.
It does.
Well, we've covered a lot of things today. Is there anything else that you think would be helpful to our listeners to cover in the mortgage process? Anything that we didn't catch on, or you want to go back and say, hey, let's dig into this a little deeper? Or do you feel like we've covered a lot for today's podcast? I
feel like we've covered a lot for today's podcast. I think the biggest thing is, don't be afraid to give us a call. We're here to help. We're here to answer any questions. If you find a lender who's not willing to answer your questions, then dig deeper and find someone who's here. Ultimately, we want to help you buy that home. We want to put you in that home and make all your dreams come true.
So you heard it from Erin. Mortgage lenders like to have you reach out to them and talk to them all the time through the process. Erin, thank you so much for joining us today. We really appreciate your insights and the knowledge that you've been able to share with our listeners.
Absolutely, Andy. Thanks so much for having me. This was great.
This has been another episode of the Smarter Money Life podcast powered by Forum Credit Union. Please leave your thoughts in the comments and be sure to look for our next episode wherever you get your podcast. Remember, now is a great time to make a difference in your financial life. Until next time.